Wait, so what are capital markets again? Okay, let's take a step back here and take a look at the world of finance from the perspective of investment banking finance bros. The finance world is all about risk. Well, also money, but anytime you try to make more money, you take on risk. Now, when a company tries to sell its securities, they want to get the best price, make sure that they sell it all and do so pretty quickly. But these companies don't know who to sell these stocks or bonds to for the best price and don't really know how any of this works. So the bankers see this as an opportunity to get paid.
First year, or any year, you just don't have a life.
Investment bankers are kind of like the fixers of the money world. They're not the kind of banks that you deposit money into, and they're the banks that, help the largest companies solve their money problems. How do I get people to buy stocks in my company? Where should I put my money so I get more money? How do I repackage my dope so that it looks higher quality? Sorry, not dope, but collateralized debt obligations, which also sounds just as suspect, doesn't it? So they come in and say, we'll buy your stocks or bonds, all of it, but at a small discount. Sign this and we'll give you the money without any hassle. The thing that they sign is called a underwriting agreement, which is a contract laying out how all this works. Banks are generally scared of big purchases like buying all the stock or bonds of a single company outright. What if they can't sell it right away? What if something goes horribly wrong with the company? A lot of Wall Street is about catastrophizing and convincing people to pay money for it. So the bankers bring in their banker friends to invest with them. Safety in numbers, right? Each bank invests less, and if something goes wrong, then it's not as big a deal. This is called a syndicate. The syndicate is a group of these banks, and they share the pie of buying the company's stock or bonds in different ways. Usually, bigger the pie that you buy, the more say you have in how the deal runs. There's also popularity contests among banks running in the background called league tables. So the bank in charge, the lead underwriter, often gets the biggest cut, and they get better deals, and they get to have their name in big on the first line and on the very left of the prospectus cover, which apparently is a big deal.
And I get it. I'm not good enough. What I don't get, Mike, is why you didn't have the courage to just come and tell me that yourself.
But sometimes it pays off just to tag on to a deal, even if it's not the most profitable, just to go up the league table. Each bank in the syndicate gets a portion of the deal, and it's responsible for selling these securities to its own clients. This way, no single bank is stuck with too much unsold stock if things go sideways. It's like a buffet where each bank takes what it can handle.
What?
I'm a fraud.
Now, lawyers are bad at math, so bankers do all the math stuff, especially when it comes to pricing the deal. So how much should these stocks or bonds be sold for, or how much are they worth? They analyze market trends, run fancy models, and then they tell the company what price they think investors will pay for it. If the stocks are new, like in an IPO, or there's a new bond, then bankers have to set these prices. It's a balancing game here. They want a high price to keep the company happy because that's what the company wants, but they also want it low enough so that other people will buy it. A big part of this job is finding people to buy it, which is called building a book. They go to hedge funds, other rich people, other banks, and anybody who has a pile of cash they want to use to invest. They also negotiate amongst themselves who's top dog and who can do what, and then they send the lawyers in to translate all of this into a contract. Again, the underwriting agreement. This is the main document that spells out everything. And it's hotly contested, which means that it's the lawyer's job to reflect any changes by the parties and put that in the agreement in writing. It lays out, who's going to do what, who's taking what risks, and who's getting paid. By the way, the underwriting agreement is between the banks and the company. So both the banks and the company have their own lawyers. There's a bunch of stuff that goes into this agreement because contracts are usually used as a tool to plan and distribute risk. It details what happens for every catastrophe you can think of. It's outlining, what the parties represent, meaning what they promise. For example, they're following all the rules, have the money, or promising not to do anything bad. Now, when it comes to underwriting, there's two main types. There's a firm commitment where a bank buys all the securities from the company and then tries to resell them. If they can't sell them, tough luck. The banks are on the hook for it anyway. This is the standard deal because companies want certainty and they want their money. And they're paying these bankers a pretty high fee. Another type of underwriting deal is called best efforts. Banks usually try to sell the securities, but they don't want to guarantee anything. So if nobody wants to buy, the company's out of luck. This happens in riskier deals where investment banks don't want to take on too much exposure and be stuck with stocks at the end of the day.
We're using the timing of our client's contract expiration to try to shake us down.
The banker's job is to sell the securities so that you can make a bit of profit off it. It's a story as old as time. It's like buying a large number of hats and knickknacks from a manufacturer and reselling them at a higher price for profit to convenience stores around Ontario, which is what my dad did to help us survive when we first came to Canada. There's also a bunch of stuff that bankers send lawyers to do. A big compliance thing is the prospectus, which is a document outlining all the details of the stocks or bonds that are going out, as well as details about the company itself. This goes out to all the investors so they know exactly what they're buying when they're buying a piece of that company. Remember, there's a lot of stupid forms and rules that you have to follow. So usually the most junior lawyer has to do all this grunt work. Some fresh law school grad is literally pulling up the forms of the prospectus and the rules like, Regulation SK, the business and operation information, as well as Regulation SX, which concerns financial statements, and checking that they meet all of these guidelines to the rules in what's called a form check.
I didn't think I was getting an office.
There's some other things in the underwriting agreement that parties use to distribute risk that needs to be completed before the deal closes. Legal risk is given to the lawyers in the form of legal opinions in what's called a negative assurance letter. They essentially make sure that the lawyers are kind of an insurance policy, the person to blame if anything goes wrong in the legal stuff. These letters or opinions state that generally there's no legal issues for various parts of the deal. Often it's specified. It says something like the company is following all the laws and the other contracts they have are fine generally.
So the rookie called in the veteran.
No, I'm just here to watch.
There's also the accounting risk and whether the financials are accurate as they claim, which is encapsulated in what's called a comfort letter. The companies, they bring in an accountant for checking all their financials and getting this comfort letter. It's kind of like a comfort blanket, but the accounting firm just says that they've checked all the numbers and it looks good.
You're in.
There's also business risks about what the company claims and the officers of the company sign. So there's a lot of certificates saying that, hey, what this company claims, I as an executive of the company, is true. So that way it's kind of easier to sue the company if they're lying. They can also get other risks of specialty areas. So like mining, you might get engineers or environmental experts to provide reports. This is all part of the due diligence process so that if you get sued, you know exactly who to blame. Again, these are ways of managing all the different risks in a deal. And what the lawyers arrange is the formalization of this into writing. Again, lawyers are professional catastrophizers.
This isn't elementary school. This is hard work. Long hours. High pressure. I need a grown goddamn man.
Okay, so everything seems straightforward so far, haha. But there's some areas of more drama, and it's mainly because everybody's looking out for themselves and trying to maximize what they can get out of a deal. Welcome to capitalism. For example, remember when I mentioned banks sometimes need to set a price for the first time a company issues shares in an IPO? Well, banks talk to investors, they look at demand and try to keep the company happy with the price, but sometimes they underprice the shares on purpose so that there's a pop in the price and it makes the bankers look like studs.
Well, I'm not going to let that be the reason that Jenny and I don't.
Now, the green shoes or over allotment options are also another neat little trick by bankers. When they are outselling stocks or bonds, they often sell more shares than actually exist. They sell something that they don't own. It's called a naked short. But because it's done with fancy contracts, totally legal. Now, if the stock price goes up after an IPO, the banks just issue extra shares. Because of this option, they were allowed to sell them from the beginning, and they make out with a clean profit. If the stock tanks, they buy shares at a lower price, and they pocket the difference. It also helps stocks stabilize temporarily since it looks like there's demand in the market from this artificial purchase. Either way, the house always wins. It's price manipulation, but it's legal because, I don't know, the government said so. Now, bankers going out to sell the stocks and bonds on their little marketing roadshow is when they fly around to meet with hedge funds, institutional investors, and pitch the stock like it's the next Amazon. The whole point, convince enough investors that this stock is the one, even if the company itself is a flaming pile of garbage wrapped in good branding. There are even cases where bankers guarantee allocations of stock to certain investors in exchange for favors down the line. It's not illegal, but it's not exactly fair either. And sometimes executives get a little too excited during these roadshows and say things they legally can't say. There's another point here where CEOs on these roadshows often brag to the public even before the deal closes. You're not allowed to do that. It's what's called gun jumping, and guess what? The lawyers get dragged in to clean up this mess too.
Dick kick! Dick kick!
Now, bankers, they act like they run the show, but who's really making sure they don't go to jail? The lawyers. The entire underwriting process is basically a game of who can take the risk and push it on to someone else. The lawyers are the ones making sure it's all documented in contracts so nobody can claim that they didn't know what they were signing up for. By the way, lawyers get paid by the hour or on a billable hour basis, but banks, they get a fraction of the total deal price. In an IPO, sometimes bankers get up to 7%, which is insanely more than the lawyers are even charging, even if lawyers are charging thousands of dollars an hour. Now, companies hate spending this much money, but they can't raise money on their own, so they need lawyers and bankers. But this also leads companies to get their money's worth and have bankers and lawyers work 24/7 and be constantly available. For young capital markets lawyers, this is where you learn to coordinate big teams, track a million moving parts, and stay up all night fixing documents so that the deal closes without an issue. And if everything goes smoothly, sometimes the company and the banks give you a fancy closing dinner at a high-end restaurant. I don't usually get those, so, if you don't get those, there's always the next deal.
Watch your back in there, Mike.
I will.